All right, well, we're going to go ahead and get started now. Appreciate everyone for joining here, our co-webinar here with Fannie Mae. We are going to basically give an overview here of what Fannie Mae's offerings in the context of an MCT client. So that's obviously from the context of the capital market side. From Fannie Mae, we're really excited about the presenters here. We have Tammany Trefny, who is senior manager and customer approval and onboarding at Fannie Mae, and she's going to give us background on and some information on the kind of the steps required in getting approved with Fannie Mae, how long the process will take. That's always a question for our customers, and we have about for the clients on the phone. There's at least 50 of you who are looking to get approved that are on the line here. So I know you'll be very interested in what Tammy has to say. For our MCT clients on the line, especially those that deal with Fannie Mae already, Mike Toner, you guys will know Mike Toner. Mike has been our close representation on the Fannie trade desk for going on a decade now, and we all love Mike, so we're excited to talk to him about the move from for those of you that are still looking to move from cash to MBS, what's involved there. Some things to look out for. Obviously, this was, frankly, the primary focus of, I would say, the first and second quarters for a lot of you out there who, thought that, not only the 1.5 billion cap was going to go in, but then maybe that cap would change in the future. And of course, you all have, growth plans. So there's still reason, to make that, analysis to decide whether or not you want to continue with some of the steps that you already embarked on making that change. So I know we have a lot of clients on the line right now that are real interested in what Mike's going to have to say there. And then last, but certainly not least, is Stephen Pawlowski, who is the SVP of and head of single family products and solutions. And so that right there should tell you about his importance. But for those, especially those lenders on the phone that are not MCT customers, you may not know, kind of what Steve's really responsible for and his groups are responsible for. But if we take it back, basically 6-7 years ago, there really were no APIs that existed to drive basically the back end execution, to be able to drive that to the front end. And Steve and his group are really responsible for the first APIs in capital markets, frankly, when it comes to the loan sale execution. That's been big for us and our clients on the line, of course, through products like Fannie Rapid Commit, which have been really successful. But just to take a step back, I think it's important for us to describe the importance here of these APIs, not just from the context of technology and automation. It's price transparency, which is absolutely essential when you talk about specified pay-ups, which we're going to talk about here a little bit later. But if you think about why, for those of you that know what I'm talking about, if you think of why a specified pay-up exists, that exists because the borrower, generally in a lower loan balance loan, is not going to have the financial means or the financial reason to get out of that loan, even if it's a higher than market interest rate. And that's why, of course, a security buyer will pay more for that security. If you think of that borrower it's absolutely essential that the transparency is there for the pickup that loan's going to create, so that that borrower is able to get that benefit on the front end. And without these APIs, you simply do not have that ability. And you guys can, for those of you selling to aggregators, you'll notice that it was about 5 or 6 years ago that these specified pay-ups moved into the rate sheets, and now of course they're prevalent throughout the aggregator space on rate sheets. So yeah, real excited to get started here with that. I've just got some questions. It's going to be very conversational. We're going to start with Tammy, like I said, then move to Mike, then Steve, and really, probably we may have some time for Q&A, but if we don't get to that, we'll be able to we'll definitely follow up with your questions like we always do after the webinar. So if I can jump right into it, as far as getting approved with Fannie Mae, Tammy, this is where frankly we're not at all familiar with the steps because we kind of deal with, we just add the execution in. Maybe you can just talk to us about what are the basic steps in getting approved to start with.
Absolutely. Well, first of all, thanks for having me. It's great to be here. And I wish I could say that we were running a holiday special where folks could just submit an application and we grant approval and we wouldn't have to do anything else, but unfortunately that's not happening. So let me talk to you today about really what the steps are to take in order to seek a direct relationship with us and ultimately achieve approval. We've spent the past 24 plus months really developing a lot of resources and improving our website to ensure that we can provide information to folks who are interested in getting a direct relationship or having a direct relationship with us, providing enough information for them to really do a lot of research up front to understand what our eligibility requirements are as well as what our process looks like. So the first step that I would encourage folks to take is if you're exploring the possibility of having that direct relationship with us, you should visit our website. We have a partner with Fannie Mae page out there. And when you get out to that page, you're going to see a number of resources available that'll help you to get started. And we really take it step by step. So really the first thing that you want to do when you look at the information out on our website is you really want to assess whether or not you are ready to do business with us. And there are a number of resources you can leverage to do that. The first one is our Path to Approval Toolkit. And our Path to Approval Toolkit really outlines specifically what the eligibility requirements are, what are we going to look at in terms of conducting a review of any documentation that is submitted, and really just making sure that you understand what are the basic elements you have to have in place in order to consider even submitting an application. Next step would actually be to review something called our Lender Approval Process video, and that takes you through the various steps. So what happens once you determine you're ready to submit an application? What happens when we get the application? How do we engage with the applicant, and where do we go from the initial application to getting you into the process to issuing a final decision? And we have a number of what we call risk self-assessments out there that really help you understand some of the things that we're going to require you to have in place in terms of policies and procedures. In particular, I'm going to draw your attention to quality control, because quality control is one of the areas we're going to evaluate pretty thoroughly. We're going to require you to have policies and procedures, written policies and procedures in place that meet our criteria. And we have a great document out there in the form of a QC self-assessment risk tool, if you will, that can help you understand if the current QC policies and procedures that you have in place today actually meet our requirements. And if they don't, we're going to provide some guidance for you on how to shore up any existing gaps so that when we're ready to move forward, you won't have any issues with quality control. So that's the very first step that you should take in the process is going out to the website, looking at all these resources and determining, do I meet the basic qualifications today in order to submit an application? Let me talk to you about what those basic qualifications are. So essentially, we're going to look at a number of categories. The first one is going to be your financial position, right? We require a minimum net worth, $2.5 million. If you're coming in for servicer in addition to seller, and you already have servicing loans, whether they're portfolio loans or other agency loans, we're going to require you to have additional 25 basis points of the entire UPB that you're servicing, in addition to that minimum $2.5 million in net worth. And we have some minimum capital ratios you have to have in place as well. I believe it's 6%. For credit unions, it's 7%. So if you're a regulated entity, whatever your regulator's requirement is based on being well capitalized. So that's it from a financial standpoint. Oh, and one other thing, we're going to look for a history of profitability. So we're going to ask you for 2 years of audited financial statements. We are specifically looking at the last 6 quarters. We want to see consistency with profitability over the last 6 quarters. So that's it from a financial standpoint on basically what we'd be looking at. I'll be honest with you, the $2.5 million net worth is the bare minimum. If you're just borderline $2.5 million, you probably want to give some consideration to waiting until it's a little bit stronger. Not that we wouldn't look at approving if you're actually at that bare minimum, but the stronger you are, the better likelihood you have in moving forward with the application. The second piece, I'm sorry, go ahead, Phil.
No, I was going to say that. No, that's great overview. We a lot of our, I would imagine there's a lot of clients who probably are maybe even typing this question in the chat now. Is there a kind of a ballpark that you have on how long the approval process would take?
I do, yeah. So once you submit an application, we would have, my team actually conducts a number of phone calls to validate the information, do some kind of pre-screening questions, and then determine whether or not we're going to move you into the actual approval process. Once we make that determination to move you forward and actually require a documentation package from you, from start to finish, so app to closing or final decision, it takes just about 5 months. And that's a significant improvement. Many of you may have tried this years ago. We were upwards of 11 months at one point in time, so we have significantly improved the process, and it's running just about 5 months right now. So
that's that's great. That's definitely I think a welcomed answer. As far as what are some hurdles that a client might run into in the process?
Sure. The biggest one that we see today is insufficient quality control. And like I referenced earlier, we're going to ask for written quality control policies and procedures. And stuff may look great on paper, but we're also going to test against those policies and procedures. So we're going to ask for QC production reports, closed loan reports, and we're going to pretty much test that against the policies and procedures. And we're going to be looking for things such as management oversight, pre-funding QC, post-closing QC, appraiser overview. How do you evaluate appraisers? What kind of review are you doing there? Internal audit. If you're doing third-party originations, what does that process look like? How do you protect NPI? If you're servicing, what are your servicing policies and procedures look like? So we're going to look at all of that. But today, the biggest issue that we see with folks is on the QC side. It's just inefficient. It doesn't meet our qualifications, or if it does on paper, they're actually not doing what they say they're doing. So it may sound great on paper, but when we do the testing, we're finding that there's a huge disconnect between what they're actually doing from an operations standpoint compared to what they have in writing.
So, with regards to the kind of some of the benefits of getting approved, our clients, whenever lenders are on a webinar with MCT, obviously execution is top of everyone's mind. So I think everybody, understands the value of having the ability of that retained versus release decision, or potentially co-issue. What are some of the other benefits of getting approved?
Sure. So, first and foremost, it's like going direct to the source when you're talking about product availability, right? So we have a ton of innovative, what we call mortgage solutions based on types of products that are available today to serve both first-time home buyers, or if they're repeat buyers. We've got a slew of products that are readily available. We've moved most of our products to our selling guide, so done away with most of the variances on product availability. So you have these available to you immediately upon getting approved with us. I mentioned pricing. You mentioned pricing, execution, clear and consistent pricing. We're in all markets at all times. Are we going to be the best every single day? The answer is no. But are we going to be competitive? The answer is yes. We've got a lot of powerful technology solutions. You think about desktop underwriter, you think about desktop originator, you've got early check, you've got collateral underwriter, you've got UCDP, you've got a slew of APIs. So all of this is available directly to folks that are direct sellers to us. You've got an ease of doing business. We don't have any credit overlays. We don't have any junk fees. We don't have pre-purchase reviews. DU is what DU is how I like to say that. We've got fast funding times, right? So the day that we certify the loan, we fund the loan. So quick funding times and, dedicated account teams that are at your disposal to help with all facets of your business. So really a number of reasons that, having a direct relationship with is certainly a benefit.
Well, that's awesome, Tammy. Really appreciate it. I think that's a great overview of the process. And like I said, I think for there's a few dozen lenders on the line right now that's probably frankly the most important part of the webinar and their first step. So I really appreciate that. So moving on to, because I know we have a lot to cover here, and there's going to be contact info at the end of this presentation as well for getting in touch with Tammy's group as far as getting the approval. So Mike, it would be we had a lot of excitement earlier in the year with the PSPAs coming out. And I think just, everybody on the line probably has heard way too much about this, but basically just to kind of level set for everybody, we had these proposed 1.5 billion per agency cap on the cash window. We'll definitely, not sure if Mike wants to give his opinion on where that's going to go in the future. I'm actually going to guess he doesn't, definitely. Nobody really probably knows. But at the end of the day, we did several webinars on this. We felt, because of the value that the cash windows bring to, like I had said earlier, as far as price transparency, that was definitely a low limit. With all of that said, it did spark a movement of mid-sized lenders, which probably makes sense as they continue to grow. It sparked a movement of lenders to begin to look at at MBS and cash versus MBS. So Mike, I was wondering, maybe you can just give us just a high level overview of the differences, and then maybe maybe move into what the process is for getting approved as a MBS for MBS guarantor delivery.
Yeah, sure, Phil. Yeah, so why don't we start? Maybe we can start with going kind of from cash to MBS. And look, just to be clear, moving from cash to MBS, it doesn't happen overnight, right? There is kind of an official approval process you go through with Fannie Mae to kind of move from one execution to another. A lot of checks to boxes, but I think as you were saying, that talk of that $1.5 billion cap definitely got things moving kind of at the beginning of the year. And I think because of that, we definitely reevaluated the process to kind of get that MBS stamp. Prior to that, you might have a couple lenders during a given year that might move from cash to MBS, very small number. After that announcement came out, obviously that changed the dynamics of everything. We dedicated a lot of resources to the process, trying to streamline it, trying to make it easier, trying to make it better. Obviously things have changed recently, and I would just say just something to keep in mind is that change, it's, that $1.5 billion cap, it has been suspended. It has not been terminated. So I think it's good to always kind of take a look and keep your mind on MBS and just take a look at it and see what it has to offer. But I think the key there, really, the first thing you do is just to educate yourself on MBS and determine if it's something really that you want to move forward with, right? Because it's a big step. It's a totally different monster as far as execution. In Fannie Mae, like I said, we've revamped our resources. We have a ton of them. They're out there. They're all online. You can go check them out. But I think the main one, and we'll make sure you guys get links to all these resources, but the main one really is, it's called the Mbs Toolkit. It's on fanniemae.com. It's an excellent resource. It is literally going to walk you through step by step everything you need to know. What are the requirements? What are the steps? Best practices? It's just a good one-stop shop to get started. So I think after you do that, I would recommend having internal conversations with whoever you need to have to, whether it's capital markets, your CFO, board of directors, chat with them, get them on board, make sure everybody's on the same page. And I think once you get to that point, your next step really just reach out to your relationship manager at Fannie Mae. You'll have an initial discussion. They'll probably loop in your capital markets account coverage from the desk. And really what it's going to kind of do is go through everything, go through the details, and really just trying to figure out if it's a good fit, right, for us and for you. And also, too, I definitely would recommend using MCT. I mean, you guys, MCT has a ton of capital markets veterans who have a lot of experience, right, with all executions, including MBS. Great resource. So you guys are definitely in good hands with MCT, so utilize that. And look, at the end of the day, the last thing we want to do is set anybody up to fail. We just want to make sure it's a good fit. We've seen lenders do it where they really push for MBS. It didn't actually make sense, but they wanted to do it. We're not going to try and stop you. We're just going to give you the tools and resources you have, and you got to kind of figure out on your own if it makes sense or not. But anyway, reason for the process and education is key.
And obviously another highly asked question along with, that Tammy gets as well. As far as how long would the process take if somebody, let's say, God forbid, as you said, and I should have made that clear earlier, that it's suspended and not terminated. But God forbid the 6 month 6 months kicks in. How long of a process is this generally?
Yeah, and that really, it's a real tricky question to answer. And once again, remember, it doesn't happen overnight, not with the flip of a switch. But, there's just a lot of moving parts with going from MBS to or cash to MBS. And really, I think it really highly depends on kind of the amount of expertise that you have at the lender shop, right? I mean, prior experience definitely increases the approval time. Obviously, starting from scratch will just lengthen that time frame. Do you have a devoted capital markets team? Are you already issuing GMA securities? I mean, there's certain things that are going to make it easier. But still, like I said, a lot of moving parts, a lot of requirements. We just want to make sure that if you start issuing MBS, it is a good fit. I can't emphasize that enough. But I think best case scenario, and look, please don't quote me on this. This is based on past experience, but I think, best case scenario, it could probably get done in 2 months, take it across the finish line. But look, I've watched lenders who I thought were extremely savvy and efficient. And look, you have other stuff going on. I've seen them take 6 months. So it's a wide range. If you have a dedicated team, you're on board with all your Fannie Mae contacts, you're talking all the time about it, getting all the documents in, signing all the forms, I really think 2 months is probably a best case scenario.
And just to follow up there, like you were saying, there's a lot to this process. To be clear, a lender couldn't expect to 5 months with Tammy to get approved and then 2 months with Toner, and so they're 0 to MBS delivery in 7 months, right? It doesn't. You guys are looking for somebody to deliver cash for a little while. Is that a fair assumption?
That I think that's a fair assumption. I think if you're getting approved with Fannie to come in, start with the cash window and kind of work your way into it, we get comfortable with the volume we're seeing from you. Proving that you're financially able to do everything, and then from there we can have that conversation. But I mean, we can start the conversation as soon as you want, but I think ideally get approved, and if you've never done securities before, just get comfortable with the cash window, dealing with Fannie, and then we can tackle that down the road.
Awesome. And Mike, you had mentioned it's all in the MBS Toolkit online, but maybe you can go through kind of some steps of what kind of preparation would be required from we can get into pricing analysis later. We did a lot of work on that earlier in the year, but operations, contracting, delivery.
Yeah, I mean, look, yeah, once you kind of, if you do go through it, right, and let's say you did get approved, I mean, as far as the guarantee pricing, yeah, we can talk about that later, but I mean, obviously that's going to become a big part of it, right? We're going to need to determine your pricing. The main components are the G fee and the buy down grids, right? G fee is just going to be a factor of your book of business and what it looks like. What are you selling to Fannie? How does it perform? Prepayment, credit profile, are we getting recognized? Many parts go into it. And then, then you have the buy down grids. We issue them kind of once a month. Kind of the day you get them is the day that you lock them in, right? So once you have a price, you kind of run your best X. Hopefully a lot of it comes to Fannie. But once you have your best X, really, you're going to need to take down kind of an MBS commitment, if you will. It's very similar to cash. You log into our system. It's called PE MBS. It looks and feels just like PE whole loan. So the same concept. You're coming in. You have some loans you want to sell us. You're going to commit to it. So you kind of lock it in. And look, I've been doing this for a long time, and trust me, the concept of paper contracts and locking in G fees for 6 to 12 months, it's definitely, that is a thing of the past, right? We're not seeing that anymore. That's the reason we kind of created this process in this system. So once again, you log in, you see your price, you hit it, very similar to the cash window. Some people think that could be good or bad, but, once again, I think doing transactions month to month, the market can move for you, it can move against you, but in my opinion, I think it's just a better way to kind of execute. But I think your question about really operations of the system, that's a big component of it because it's all different than kind of doing cash. And I think, once again, I go back to using, when you come in as a lender, you get a Fannie Mae dedicated team with an assigned expert in that kind of area, and they're there for you to use them as a resource. So, once again, I'm the capital markets guy. I'm not really exposed all to it, but we have the teams here to support you. We have the resources. The key is to go through the process, kind of use us, take our expertise, go through it slowly, get it right, and make sure it all works out at the end of the day. But we do have resources and people here at Fannie that'll walk you through everything and help you get there if we think you think it's the right way to go.
And Mike, to jump into the pricing analysis, so a big component obviously is someone takes a TBA security and works it through the G fee that you've given them and the buy down grids, and maybe some other adjustments that you guys can make on the desk. A lot of times that won't match up to the cash window price, and of course, I know we have a limited amount of time, but maybe you can talk a little bit about the wrapping in and giving an applied lower G fee because maybe there's other specified pay up product in there, but also just in general, kind of what goes into the pricing analysis there, because you're obviously, from an MBS delivery, you would want to take into account, what your spec kind of profile looks like.
Yeah, and I'd say, to your point too, I'd say probably the main reason that lenders kind of go to that want to do MBS, right? Look, there's kind of this myth out there, and let's just chat about it really quick, right? For example, let's say you go to TAMI, you get approved, you come in, you start doing, and you're all new to this, you start doing best efforts, right? You get your best efforts price. You do that for a few months, you get a little bit more savvy, you hire somebody like MCT, things are getting better, then you jump to mandatory, and then you get that nice, kind of, depending on your pull through, I don't know, you definitely will see a price improvement going from best efforts to mandatory. Then you do mandatory for a little bit, and I think there's a mindset that I'm going to go do MBS and, that everything is going to kind of improve, I'm going to get another bump up in execution, and it's not exactly the case, right? And I think, obviously the big motivation we hear from lenders who want to go to MBS is that there's this kind of concept that they're going to get better pay-ups in the market than they do via the cash window. It's also not the case. You think about it, lenders that are doing MBS today, they've been doing it for a long time, well-oiled machines, very efficient with execution and pooling system. They're issuing securities in larger volumes, right? I mean, everything's kind of going MBS. And I can tell you this, I mean, the concept on the street is size opens eyes. So if you think about it, if you take a $50 million bond, a security, and you compare it to $1 million bond security, and let's say all else is equal, they're not going to trade the same, 9 times out of 10. The bigger volume, the bigger bond is going to probably get a better pay up. that's just kind of the reality of it, right? So, when you go into MBS, you're kind of taking on that responsibility, right? You are now the cash window. You sell me loans for the cash window. Fannie Mae securitizes them. We put them out of the street. We get the spec pay up. We push it back through the cash window. You get it there. That was one of the reasons we put out the spec products, because people couldn't see it and they wanted to see it. Well, now it's out there. You go into MBS, and once again, you're now on your own to kind of get those spec payups. And you may see certain entities trade larger volumes and see those spec payups, but there's no guarantee that you're going to get that exact payup in the marketplace. And the other piece too, with MBS, I mean, a lot of it's going to fall on you. I mean, it's like the reputation of being out there, is now on you. And when you're issuing securities, it's kind of there's a lot to deal with. I mean, there's a lot of focus on prepayments, rep mix, profile, disclosures. I mean, at the pool and loan level, investors take those disclosures and they make pretty important decisions based on that. And if you start having issues with any of those, right, among other things, the street can be very unforgiving. So you get security, you start issuing them, there start to be issues, the payups that you're getting from the street may get deteriorated because of those types of issues. Once again, a lot of reputation risk that comes with kind of doing MBS.
Yeah, and Mike talked about the size there, but just to reiterate, he talked in the when he says size opens eyes, and comments like the street is unforgiving. Remember that Mike was describing small bond versus big bond. There's also you have to hit minimums. It's either a volume or a 20 loan minimum for a given liquid specified payup security in certain cases. And so if you think of that in the context of an $85,000 loan balance, especially with property values the way they are now, those are pretty few and far between. So the ability to get that urban legend $85,000 pay up, to get that on a rate sheet for one loan is incredibly beneficial to small but even mid-sized, borderline large lenders. And that's really been our point all along, or what we've what a lot of us in the market have tried to say about the benefits of the cash window for smaller lenders. So Mike, we talked about pay-ups. Maybe we could go into, we've had a couple questions over the last few days, as we've had a nice, definitely a nice pop that I don't think anybody's complaining about on the conforming loan limits there. So, nearly $100,000 move. Obviously that's, those, everybody sees those numbers. The benefits are kind of obvious. There's some other, more complex things that go into de minimis minimums, and we can talk about if we have enough time there. But really, a lot of our clients, ask about those specified pay-up tranches that you guys give. So on the cash window, we will see a pay-up for any loans that are under 200,000, for instance. That was the top for a long time. Now I believe there's a 250. As you see this conforming loan, limit go higher and higher, do we expect new tranches to open up? And maybe talk a little bit about how that occurs.
Yeah, it's an excellent question considering the timing of that announcement. Look, I've been doing this for a long time, and I think that's the largest increase I've seen on the loan limits ever, at least in my time frame. Obviously, look, we trade in the spec market. When I say we, once again, as I said, Fannie, we buy the loans, we securitize them. We don't really run a portfolio anymore, so we're issuing large size bonds out there, trading them, right? So we're looking for all the payups that we can get, and once again, when we get them, we want to pass them on to the cash window. And so I think, the key is for those stories, right? You just can't create them. They got to form. Volume has to hit it. They need to get liquid, right? It's got to be a liquid market out there. And so we're constantly looking at it. And as you said, Phil, I think today the max we do is 250. I think when we first put the specifieds out there, we went up to 150, right? And then we went to 175, 200, the whole story. And as we're doing that the entire time, home prices are just kind of going up, right? And this year, 18 to 20%. So what I think we're going to see here, I think right now, even though we cap it out at 250 on the cash window, I've seen some 275s out there trading, depending on who you talk to. I've seen some 300K stories trade, with them. I think they're barely trading around new prod, so I think it's just easier to put it into a new prod pool. So not seeing a ton of it right now. But I think the key is we get in the first year because, technically you can't deliver these volumes until January 1st. Volume comes in, we're going to see the story start to kind of develop, and the key is it's going to get liquidity in those pools. And once we see liquidity, our goal, if we're getting the payout, once again, we want to pass it on to our lender partners. So as those products develop, they'll get out there. One of the key things you got to think about though too is as you're issuing securities, as we create all these different tranches and products, right? Then all of a sudden you start having an increase in number of pools and a decrease maybe in average pool size. So remember we talked about that fact that, the larger pools get bigger payups. If you're starting to chop into your volumes, you got to factor that in too. That's a part of it. But anyway, to answer your question, I think naturally, in my opinion, based on these huge jumps, these stories are going to continue to evolve. And as they do, I would imagine as a good partner, we'll put them out there in the cash window. But time will tell. Let's just get the volume in and see where the stories go.
Oh, that's great. That's great. So, and with, just along the lines of stories and how you pass that through, maybe you can talk a little bit about, a move to the fact that Fannie can't be put in an arbitrage situation. Can you talk a little bit, Mike, about customers who want to do cash and MBS, if there's kind of a timeline there, and kind of what you guys are going to be watching for?
Yeah, excellent question. So just to be clear and transparent, it is difficult to do both. Look, I can tell you that the majority of lenders that sell to Fannie Mae are using the cash window because of the obvious reason. It's simple. You commit a loan, you get a price, you get certified, you get funded. Very simple, very easy, right? And I get that others want to move over to MBS. But as you do that, if your motivation to move to MBS is to get better execution via whether it's better payups or whatever the reason is, naturally over the course of time, you're going to start shifting your cash business, probably taking the primo stuff that we're probably looking for, and you're going to be creating your own pools and getting the pay up. So at the end of the day, and not to say that anybody would do this to be malicious on purpose, it's just natural way of doing execution. It tends to happen. We end up getting maybe TBA or what we call worst deliver, right? So you go through, you pick everything out, and then you send it through the cash window. We track that very closely. And if we do see that, obviously we would have a conversation, and if it continues, it could possibly, result in a worsening of your cash pricing. So it's hard to manage both. Not to say that it can't be done, but just in my history and what I've seen, usually somebody picks their execution moves. And also too, once you kind of do that, it's hard to go back and forth. So it's not like, hey, I'm going to go to MBS and things aren't so great after a few months. And if we didn't get anything, then you try to jump back, and then you got to prove to us again that your cash volume is going to be back to where it was. It's just difficult. Can it be done? Yeah. But usually I'd say most entities have picked an execution and move forward with it.
That's great. That's great. And yeah, for all the lenders online and the MCT clients especially, we've gone through this in prior prior conference calls, and you probably talked with your trader ad nauseum about this. But yeah, it just makes mathematical sense, right? That if to the extent that your cash conventional 30 TBA price has any improvements in it because of the profile of the product going in there, it makes mathematical sense that you couldn't take all of those products out, right? Take all those loans out, securitize them, specified, and then shovel the fastest paying loans into that Con 30, into perpetuity. So that's definitely important. So, sorry, Mike.
No, that was, I totally agree with you. And it's like I said, it's just the nature of how it works sometimes, and that's why it's hard to do both.
Yeah. And look, as far as the nature, and malicious, definitely not malicious. Everybody's, it comes up as the best execution on the screen.
Yeah.
And so, and so it's important, and obviously Mike can, walk you guys through that. But look, that was great. I mean, if we looked at the evolution there of getting approved from, with Fannie Mae, going through the process to, eventually evolve and become an MBS delivery lender. What I'd like to do now is go to Steve, and as I talked about in the opening, Steve is responsible for, and his teams, he'll tell you, are responsible for a lot of the technology improvements that we've seen in secondary on the loan sale execution side. No, Steve, we're really excited to hear from you, kind of where the latest technology technology gains are in the capital market space.
Yeah, thanks, Phil, and I appreciate it. It's a team effort when we drive some of these technology solutions out to the market. But when I think about capital markets technology, there's really three areas that we're focused on: execution and committing, servicing, and funding. And when we think about execution and committing, there are really two main solutions that we're building out on, and that's Market Point and MBS Auto Trade. So when we Market Point, the best way to explain it is it's really Market Point's like an end-to-end platform, or just a single dashboard that basically is a one-stop shop for lenders in the secondary market as far as interacting with Fannie Mae. At some point in the future, what Market Point will be is we'll consolidate all of our committing and transaction applications like P Whole Loan, PMBS, MBS Auto Trade, which is fairly new, and they'll all be consolidated into this dashboard where you'll be able to pull down pricing, transact, or commit. It will allow basically users to browse, download price, do their best efforts, commitments or mandatory commitments, hedging, buying and selling, servicing, all through this single platform. And then on top of that, we got MBS Auto Trade, and we started developing this application about 2 years ago. This is basically an online trading platform that enables lenders to really just electronically trade TBAs and dollar rolls with Fannie Mae. It's a easy-use portal that helps speed up the trading timeline. And really, the main feature of it really is to reduce the operational process and cost of error risk that is really inherent in the execution trades over phones, because everything is done electronically. Enables lenders to pull that in if they want to, right into their trade logs and into their back office. And then regarding the servicing aspect of it, from a buy-sell perspective, we created Servicing Marketplace a few years back. We're spending a lot of time enhancing those capabilities and features, and really trying to make this robust servicing trading platform for co-issue servicing. Enables lenders to concurrently sell a loan to Fannie Mae and then turn around and sell their MSR to a servicing buyer of their choice. So the Servicing Marketplace is really bringing together the lenders and the buyers in an easy, consistent, and transparent process. And then the last thing is our funding, right? So we have an early funding program that we started to enhance last year to really help drive faster funding times for our lenders. So for these lenders that are leveraging MBS, for an example, our early funding programs enable us to provide trade proceeds in advance of settlement. Through this system, we can provide faster funding timelines, such as same-day funding, which reduces their overall funding costs, as well as help them manage their warehouse lines. And we've been spending a lot of time on that, consolidating reportings, driving real-time data, email alerts, and as I mentioned before, same-day funding.
That's awesome, Steve. Maybe we talk a little bit about go into a little bit more on Market Point, and in the context, because I know there's a lot that you guys are doing there, and you mentioned PMBS, so there's definitely an aspect of market MBS pricing, in your whole loan execution. Currently, you have these monthly buy down grids. Just from our perspective, doing best executions, it makes sense that the live execution, considering that there are market drivers to those values in those buy down grids, it would make sense that there's at the end of the day, the more efficient price is the live price, which you guys have driven so much efficiency on the cash window side. Do you see that world eventually moving to more of a live buy down grid?
Yeah, I think at some point in time, as we become more dynamic and our infrastructure allows us to be more dynamic, I could definitely see us becoming much more accommodating to real-time buy down pricing. Right now we have late and early, but as we definitely build out those capabilities, that's our goal, is to be dynamic as possible, to be able to manage our returns and our capital, as well as profile mix of business.
And so, and then talking a little bit more about S&P. Look, that was another huge huge step forward for our customers in the flow, concurrent servicing, liquidity side. The API has been great. We have a lot of customers delivering to that. Great in a lot of ways. That was a concern when we were presented with these $1.5 billion caps, that customers were not going to have access to that anymore. Is S&P also, is it in the works for MBS delivery, or is it already?
Yeah, to your point, Bill, S&P has really been a whole loan type of execution, and we do have what we call S&P Lite for MBS, but it doesn't have all the features and functions and capabilities that the S&P does for whole loan. And we will, in 2022, one of the things we're looking at is, not only looking to enhance that on the MBS side as well, so that we can bring some of the value adds that lenders are seeing in S&P into the MBS space as well. So it's definitely on the backlog.
That's awesome, and look, specific to that point, because again, to credit you guys, the technology really did, that provides this granularity in pricing, and the efficiency in pricing really did stem from you guys deploying those initial APIs. Steve, and we might have already talked about them, but what are the primary kind of steps that you see going forward in kind of that constant march to further and further granularization in price, and kind of how's that, the project to automate some of those changes, how's that going, and where do you see it going in 2022?
Yeah, so when we talk about more granular pricing, one of the things that we talked about all the time with our group is that, as we become more dynamic and provide granular pricing where we can, we want to make sure that we're leveraging the technology like APIs and Market Point to make sure that we're really connecting and making it easier for lenders to consume that pricing. With Market Point, which will really probably be a really key to that in streamline the pricing committing, is one, we're hopefully going to allow users to automatically download pricing through Market Point, but the real feature there will be the ability to upload a file for pricing purposes and be able to obtain a price and also a service and release price at a low level. So the goal is really to leverage that technology and APIs to really help lenders, and MCT, you guys have been a really big user of our APIs over the years, right? Matter of fact, you were the first one to integrate into MBS Auto Trade from a TBA dollar roll perspective, and I think that's part of the TAM platform. You've also leveraged a lot of the pricing capabilities around Bryce Prowse, make and manage whole loan commitments, and we'll continue to do that. So as we get more granular, our goal is to really leverage that API to fit into your process to be able to serve our customers.
That's awesome, and yeah, I'm glad you brought up MBS Auto Trade. We talked with Mike in the context here of loan execution, but for years we've dealt with Mike on the TBA desk, and that's been a great source, obviously source of liquidity, and the audit trade is definitely a game changer in the in electronic trading.
Yeah, Phil, I'm just sorry you had to work with Mike though.
Yeah. And so, yeah, in general, it sounds like a lot of, continuing to move down the API route potentially. It sounds like bring some of these technology improvements to the MBS side as well, it sounds like.
Yeah, definitely. I think to your point, no matter what we do, we want to make sure that we're driving the value through MBS and the value through whole loans. So, Mike pointed out earlier, the same value you get through MBS, you're going to get the same value through the whole loan execution and the whole loan platform.
Awesome. So yeah, we talked about, I know we had a couple questions on the specified pay-ups. Let me see what else we got here. Okay, because that let's see, we got some. So is there an ability to submit loans for purchase once the application is accepted and while being reviewed for approval? And that's a Tammy question.
Can you repeat it, Phil?
Basically, are you able to submit loans once the application is accepted and being reviewed for approval?
So we do have something called provisional approval. So after we request a documentation package, we do some initial analysis. And if everything looks good from the initial review, what we will do is issue seller approval only. So you'd have to sell servicing released. You can't be approved for servicing. So you can sell prior to actually obtaining your final full approval. So yes, you do have the ability to actually deliver sooner in the process.
Okay, and we're going to get to, appreciate that, Tammy. We're definitely going to get to all these questions, but we may run out of time, so I'm going to skip through a couple. This is one that we get a lot. Will Fannie consider approving new entities that are run with individuals with experience selling to agencies from under other letters? Do the standards change since there won't be 2 years of financials originating, servicing data? And that's a question we get a lot, Tammy. Maybe you can talk about how you guys see that.
Sure. So that would be considered an exception to the standard because we do look for a 2-year operating history, 2 years of audited financials. We want to make sure that there's a history there. In rare instances, we may take an applicant an exception path, depending upon whether or not there are strong compensating factors. It's few and far between, but we have done it before. In most of those cases, should we decide to pursue some type of exception path, there likely is some type of collateral post that goes along with making that exception. So in addition to the standard net worth requirements, we would likely require someone to post a certain dollar amount of cash collateral in order to issue an approval. But those don't happen often. They are few and far between, so not something we entertain a lot.
Okay, great. Yeah, actually the question for my side here is MCT updating the S&P pricing as it changes for S&P approved servicers into your client's best execution models, and that's absolutely the case. Credit to the S&P API. We basically that price automatically updates. The buyer is responsible for updating the grid into, I'm sure the model that Steve's groups have created, but actually, Steve, maybe we could go into that for a second. just on, to answer that question, that's a huge benefit that not just MCT, but all pricing vendors, love to see when, if we think, although you're not the buyer of servicing, you the buyer of the asset, it would, it's nice that you guys are responsible for the price, and you guys assimilate those grids from those buyers into the model. How do you look to, do you work with buyers as they have more and more granularity and update how you can accommodate some of that pricing granularity on the servicing side?
Yeah. So, Phil, to your point, the beauty of S&P, right, is that when we created it for the servicing buyer as well, right? We really looked at it as a two-side approach, right? How do you make sure you're giving the information to the seller, the information the seller needs to make their execution decision? But we also wanted to make sure that we gave the tool to the buyer to be able to be as granular as they need to be within reason. I mean, we have to follow, some sort of standard within the process, but we are pretty flexible as far as allowing a servicing buyer to be as granular as they want to be able to display that pricing. And that's what's unique about S&P, is that it truly is what I would say a marketplace that really is bringing a buyer and seller together and allowing them to exchange the information they need in order to be able to execute.
And just as, since we've been talking about a lot of technology here, that is the key. What Steve's talking about there of producing that all-in return price. If you think of the world where I'm sure Steve and Fannie want to take, the S&P buying side, when there's, just a multitude of buyers out there, it's essential for the lender for that to come back in an automated price, and that's what those APIs give you.
Yep, that's right. And to your point, Phil, with connecting into your platform, right, it becomes much easier for you to pull that in and drive that seamless execution decision for the lender.
Yeah, absolutely. And so we're up at the end of time here. There was quite a few questions. So we will make sure to follow up with you guys. And we do have one more question that I'll definitely address. Will this be available as a recorded event? And absolutely. Ian and Dave and their team from our marketing side will be sending out the recording later today for all registrants. But as we come to the end here, I would really just want to really thank Tammy, Mike, and Steve. This was great. Always, all these were questions that, especially on Tammy and Mike's side, questions that come up all the time, especially this year. And then Steve, it was great to get straight from the horse's mouth on where we might be headed in the technology space on the capital markets. So I really appreciate you guys coming on with us.
Thanks for having us, Phil.